Is my screen absolutely bugging out right now? Or is that just me? In the virtual trading floor here, it looks fine. Oh, it's flashing like crazy. I've never seen anything like it before. I'm using a different software today to try to let me broadcast on multiple things at once. So I think I'm on YouTube and I'm on Twitter right now at the same time as a live broadcast. The Twitter is cool, but I don't care as much about it. If someone could just confirm that I'm at least on the YouTube, thank you, Mike. I appreciate it. Cool. All right. I am an associated member of T3 Trading Group, which is an SEC broker-dealer and member of FINRA. You should carefully consider whether trading is suitable for you in light of your own financial condition. Position disclosure here. The only thing that changed is I got out of TZA into the close. I got out of my market short that I was in that was hedging me a little bit. And then Amazon went up, so hey. All right. Oh, cool, this works better now. All right, again, just bear with me here, working with a little bit of new software. Incredible numbers from Amazon. Amazon going green here now. We'll see how this settles in. It doesn't look like we're getting the Amazon stock split. What's Snap doing on its report? Ooh, up now. And it's still down 3%. This thing was down, what, 20% because of Facebook's earnings today? Nuts. And now Pins is trading up now also. This market, guys. Oh, yeah, we got ATVI also? I didn't know Activision was reporting. I guess it doesn't matter as much because of the buyout news. Anyway, gang, this market is insane. This market is insane. This market is insane. You know, you're going to take me to the loony bin soon, the way that this market's been traded. I've never seen... the comment of the day goes to Diego. Diego said here just a little bit ago, he goes, you got trillion-dollar companies trading like penny stocks. The movements are absolutely nuts. Facebook, Apple, Netflix, now Amazon, Google's move. Oh, man. And I'll tell you what, at the same time, it seems like earnings reports haven't mattered this much in a long time. And that's because of the fear of the Fed increasing the interest rates. You need these companies to prove that they can post good numbers and that the economy isn't going south, or at least too south, to be able to kind of make up for that. So these earnings reports are so important. The Facebook thing was just so crazy. I know we were talking about it in real time yesterday as it was coming out. Continuing to drift lower. You know, a great initial uptick in Facebook this morning. I'll get rid of the pre-market price action. A great initial uptick here that you guys called. Brant, Pat, I know you guys are all over this. A couple of other you guys got involved in this as well, but maybe you didn't capture the full move here. Just great job seeing the large order option flow coming in and kind of taking advantage of it to be able to ride this move up. And then I think I was communicating to you guys into this 245 area, 244 area to take a little bit off, and then it overshot that a little bit. So that was a good trade, but then this thing just drifted into nothingness. Biggest single market cap loss for an individual company in a single day ever, I believe, is the statistic that we're seeing. Does anyone know what that number is? Is it anyone know what that number was? I don't know what that number was. 200. It is, right? I was going to say 220 billion. But then as I was about to say the number out loud, it didn't seem like it could be an actual number. How do you lose the market cap of $220 billion or $200 billion in a single day? Oh, I guess that's how. Look at that gap. Anyone know how much Mark Zuckerberg, his net worth, personally went down today? I'd be really just curious to know that number too. He went down I'm seeing 25 billion from Derrick and 31 billion from Justin. Whoo! Man, let's go to the market. Let's talk about the effect that this is having on the market. Look at it, we're up. SPYs are up $3 after the close now. This is like the opposite of yesterday. Oh man, I don't need to recap this entire year so far. 2022 is already going in the record books for insanity. Obviously, this downtrend that came in, this massive downside capitulation on this volume, which was not the low for the IWM, by the way. It just was for the SPYs and the Qs. Then we kind of had Apple come out and save the market a little bit. We had, which day was it the Apple move? It was the 28th. Yeah, and that's what brought us to the top of the bear flag. Then we broke up on that bear flag. We exaggerated the move to the upside. That got helped by Google. We closed pretty well yesterday, and then Facebook came out, and it was just absolute destruction that led to Facebook, all kinds of records, right? Facebook, the biggest individual market cap loss in a single day, led to the NASDAQ having its worst day since 2020. So it's down, I think, it was down 4% day in the NASDAQ. And we're up like $7 here in the Qs after the close. The daily candle here on my chart gets manipulated by the after hours price action. But what we're going to see on this as a candle tomorrow is going to be like a shooting star style candle in here, right? I believe. Or actually, it might just be a straight red bar. Yeah, it'll probably just be a straight red bar, actually. I take that back with a little, let me look at my 5-minute chart. There'll be a little upside tail, and then it's going to be like a straight red bar closing at lows. And tomorrow morning, we're going to gap up, and we're going to negate a lot of the candle itself, right? Just look at the 5-minute here. We closed almost near lows, and right now we're trading at 395.50 or so. So tomorrow morning, assuming we stay where we are and there's no surprises in the Amazon conference call that make things worse somehow, which I don't see that really happening, tomorrow when we wake up, we're just going to be gapping up in such a way that negates all of this candle. And it's interesting. I guess the volume's not huge today. If we were trading on really big volume and then we were gapping up and negating the entirety of that with a gap tomorrow, it would actually be pretty bullish, because a lot of people just got smoked today on positions. I mean, anybody, man, any regular people who own Facebook in their IRA or whatever, I feel kind of bad for them on a day like today. So just a lot of liquidations kind of coming in, and then we're just going to immediately be back higher. So especially if today was a much higher volume day, that could actually be a catalyst, a technical catalyst for a higher. At a minimum, and we got to see how we close tomorrow, but at a minimum, we're starting to build out that wedge that I spoke about. How instead of this just being like a V bottom, or instead of us just bouncing and immediately going back to lows, that we could build out a bit of a wedge pattern. And that wedge pattern would be technically bearish, but it'd be on like the neutral side of bearish, if that makes sense. Because the bulls do have a chance to be able to really break a wedge should it build out to the upside. But again, technically it would be bearish. Triangles and wedges are supposed to break in the direction of the trend, and the small to intermediate to medium time frame trends have definitely been to the downside. The big picture, though, big picture, we do still have a barely rising 200-day with the Qs. So that really big picture, you could argue, is neutral to bullish, whereas that smaller intermediate picture is bearish. So if we build out this wedge here, again, I would call it on the neutral side of bearish, if that makes sense. And I'm just talking about our pure technicals here. Ooh, I got filled in one of my stocks. Sorry. Whoops. I guess now you know which one it is. Okay. And Apple was holding in like a champion today. I just accidentally typed that up, actually, until the MOCs came out and they crushed it. But this Apple couldn't even make new lows on the day until the last like 10 minutes here when basically MOCs came out, as opposed to you look at the relative weakness in the Qs here. So I do think that relative strength in Apple continues to be notable as it's extended to the upside. And today I don't think is necessarily, today could be a really bad day for people. If you're involved in a lot of these tech stocks that got destroyed. Is Snap really up that much right now? Woo-hoo. Oh my God, this market is nuts. This market is so crazy. It's just back to yesterday's high. Anyway, now I totally lost my train of thought, and I had a good important point that I was about to make about it too. Oh yeah. I know where I was going. Today could have been a really destructive day for people. With just how this market traded and how weak it was, and especially when we broke down, we called this bounce really well, and then let me go to the SPYs, because the SPYs are what I was really looking at. Was I looking at the 15-minute? Why doesn't that look right to me? Yeah, I remember that high in the IWM coming in. This was kind of notable to me, these highs, and then it was the breaking of these lows, where once those lows broke and we really kind of continued to trend lower, it just was not looking good here for the SPYs and the Qs. So the point that I was trying to make was this could have been a really destructive day for a lot of people, but we navigated it as a team really, really well. Coming in and putting the shorts on yesterday morning, I know a bunch of us swung some of those shorts, so that worked out really well. And then the fact that we're in these energy names, look how well this XLE held in, right? Look, Oxy started ripping again. Apache was holding in really, really well. I actually wish that Apache did not break yesterday's high, but look at this run that these things started to randomly have here at 130. The volume really picked up. It almost seemed like there was a long short fund out there, to me, who was like long tech, short oil. Stefan's going to love this if he's listening to it. It almost seemed to me like there was a fund out there that's long tech, short oil, and was just like imploding and was like liquidating these oil stocks as he or she was liquidating tech stocks to the downside because of Facebook. It was really when the market started breaking down that these oil names, Oxy, Apache, they just started catching these really, really big bids. Exxon maybe not as much. That Halliburton break, I know my Halliburton alert went off at one point today. No, it didn't. But those energy names are still really where our relative strength is today, for sure. For sure. I really wish this Apache didn't break yesterday's high, though. This would have been a beautiful setup going into tomorrow. Let's just take a look at a couple of these. Chevron's got a beautiful inside day today. That's going to be worth paying attention to tomorrow. Even if it's not my favorite oil name, the technicals are definitely there. ExxonMobil, I wish didn't break yesterday's low, but it's starting to build out a bull flag. So ExxonMobil, I know we had the list on the list today if it could break yesterday's high as a buy, and it didn't do it. So that's still going to be in play. I actually wish this Oxy would even as I'm long it, would stop being as strong as it is, so that it could set up a little bit better for another entry. This is actually technically building an ascending bull flag, which is a really bullish pattern, but it's a hard pattern to execute, as opposed to like our Apache and our ExxonMobil are kind of building out these bull flags at these inside days. So those are going to be setups we'll continue to pay attention to. We did have XLF and Bank of America in particular on the radar today, and the Bank of America turned out to be disappointing, but it's the right idea here. It was relatively strong pre-market. It actually stayed relatively strong throughout the day. I was able to be basically break even in the trade as I got stopped out of it. Very, very tiny loss, which I would just consider to be break even at this point. We're looking for the breakaway gap, right? So the idea here was it was trading above $47 pre-market, and it actually opened up at $47.25, and I didn't want to pay up that much, which I'm glad I didn't. But they were selling this thing off pretty quickly. We looked at being long versus yesterday's high as a tighter risk trade, the pre-market low as a looser risk trade, with the idea that really the right out would probably be yesterday's low, but that was too much risk. So I ended up nibbling a little bit initially at like 47.05 or something like that, and then this first candle was just really bad. This is not, if this is going to be giving you a breakaway gap type of situation, this is not how it's supposed to react. Fine, if it wants to pull in a little bit, okay, but this thing really should not be getting much below 47. Or if it is getting below 47, it should have been just a quick tail snap right back up, and it wasn't able to do that. So I told you right away that something was wrong. I stuck with my game plan, though, of kind of giving it to 46.55 initially. I was able to kind of work some stock back and forth here that reduced my average price. I had a defensive game plan. I know somebody has a question about that. Was asking me about it in real time. I think it was ET. And I said bring it up in the afternoon meeting. So I can kind of just talk about that a little bit. So this is one of the difficult things in trading. I'm not necessarily going to advocate that what I did was the right thing to do here. And even though it benefited me, what's most important, I think, in trading is consistency. And I am not an advocate of changing your game plan in the moment. Let me start by saying that. Thanks, ET. I'm not an advocate of changing your game plan in the moment, and I'll tell you why. If you looked at a trade pre-market, like we did with Bank of America, and you created a game plan for yourself, maybe you want to take some stock long versus yesterday's high, some stock long versus the pre-market low, whatever it is, you should really follow that game plan kind of to the letter of the law. Because when you're creating a game plan for yourself and you're able to do that pre-market, you're really able to view things much more objectively because you're not in the position, your P&L's not flapping back and forth, and it's the P&L movements and seeing stocks go against you or go in your favor. It's that type of thought process that actually can create emotion. And then once you start to create game plans when you're in a state of emotion, it's going to be much more subjective than what you were able to do pre-market. So for the most part, I'm going to advocate to people, what I always say, which is buy the ticket, take the ride. You decided to take the trade, you had a game plan for it, follow through with your game plan, stick with your trade. That's going to benefit, I think, almost everyone more, including myself, in the long run. Because I'll tell you what we can do to ourselves mentally. Maybe you have 100 reasons why this trade should work, and you're able to find one reason why the trade shouldn't work, and you let that one reason get in your head so bad that you end up just saying, oh, I'm liquidating my position, I'm out, there's no way it can work. We can really do that to ourselves mentally, especially when you're seeing your P&L tick against you or something like that. So for the most part, really almost for the entirety, not even for the most part, you create your game plan, you should follow through your game plan. You created a game plan that had a set amount of risk. You are inherently comfortable with that amount of risk, or you want to make your game plan that way. And we almost need to we can't judge our success based on individual results. We need to judge our success based on the results of the whole, if that would make sense. So the only way to have consistency in trading is to have consistent profitability in trading, is to have a consistent approach to what you're doing. The only way that that's going to happen is if you have rules specifically for what you're doing. So that's what we all need to focus on. So now that I said all of that, I'll tell you about how I didn't exactly perfectly do that. So ET saying here, I guess I need to leave room in my game plan to average down in front of my out if the trade turns against me. It depends how much risk you're taking on in the trade. If you're keeping this trade really tight, if you bought 47.05 versus 46.96, you should be taking all of your stock in one shot. You should not be leaving any room to average down into the position or build into the position or anything like that. You're taking a tighter risk, more momentum style trade. And I love those trades because the benefit of those types of trades is if your trade works, you're going to have a lot of stock for a small amount of risk. It can pay you a massive risk reward. It's phenomenal. The downside of that type of trade is especially with this type of volatility that we have in the market right now, is that it can be very easy to get shaken out of a trade that still kind of works. And we all know that's one of the worst feelings ever. And that's why I'm sometimes an advocate of using multiple outs. You take a heavier position that you keep really tight, and if everything works perfectly the exact way that it's supposed to, like ExxonMobil did yesterday or 2 days ago, you have a ton of stock. You're gonna be able to make really good money for yourself. But also, if you can have a second stop that's a little bit looser and use a second out, then that's really trading more to be right or wrong, which is what I prefer to do. I know that if I'm getting stopped out, that the idea itself was wrong. If the idea itself was wrong, it's easy for me to kind of move on mentally. But if you're giving things a lot of space, you should also be leaving some space in the risk portion of your game plan to kind of add to the position and to work the position. So you guys can do the math on doubling down. And again, I always encourage people to do exactly what I did for years, which is, honestly, I used to, I'd have my sparring sessions for fighting on Friday night. I'd go out to Long Island. I would spar, and then after I'd get back from sparring, I'd have a really clear mind. I would actually oftentimes sit down in front of a computer, and I would just open up an Excel spreadsheet, and I would play with the math behind game plans. It's a lot of what I would do, and create all these different hypothetical game plans for how different types of trades with different set amounts of risk could kind of work out, and what's going to benefit me more in certain situations, just from kind of the math perspective of it. And if you do the math when you're given stuff on bigger risk like this, like so that out of $46.55, well, my first buy I think was like $47.04 or $47.05. So I'm coming in, I'm risking 50 cents off of that. That's a decent amount of risk, especially for a $47 stock. Because I was buying it kind of on the way down here, I actually didn't take the extra risk and the extra stock just versus yesterday's high like I was thinking I might do pre-market. I just had a smaller amount of stock that was giving some room to. So if you buy some stock at $47.05, and then you buy some more stock at so I was getting filled actually at $47.76 twice here. Actually, on both of these candles, I got filled at $47.76, and I think I got filled a little bit at $47.81 also. But let's just use the 76 fill for a minute and try to keep this a little bit simple. So on that, I've got 20 cents worth of risk. So let's just try to use some simple numbers here. Let's say that I bought 200 shares at $47.05 with 50 cents worth of risk. That's $100 worth of risk. Now let's say that I bought an additional 200 shares at, let's just call it $47.75 instead of 76, just to keep the math here really simple. Let's say I bought an additional 200 shares at $46.75. That's going to be an additional $40 worth of risk. So I've already got, and in a situation like this, actually, I was planned to buy more at 66, which let's just call it 65 for 10 cents risk to keep that simple as well, which is going to be an additional $20 worth of risk. Well, think about the risk add-on that you're taking as a percentage of the amount of risk that you were originally putting on. You're adding on a smaller percentage dollar amount worth of risk, but think about what it can do for you from a game planning perspective if you're able to get certain bounces off of it. So if I've got if I'm buying here at $46.75 and now I've got 20 cents worth of risk, and this were to pop 20 cents in my favor, which is just to 95. If it were to pop to 20 cents to my favor, I can liquidate half of the second buy to now have that stock for free if I want to, or I could liquidate the entirety of it and now just have my core position at a significantly better kind of risk reward. And this is where the idea of a more defensive game plan came into play for me. And the reason why I was implementing a more defensive game plan was because the market was weak and I really hated this first candle. This first candle here for Bank of America was very damning. So my two options here that I'm considering from a game planning perspective is to sell 50% of the ad at 1-to-1 to cover the risk on the ad, the same way that we sometimes do that on the core, or to sell the entirety of the ad to then just have the core from a better price, a better average price. So in one scenario here, I'll just have 200 shares from a better average price. And that's a good thing, because if I can get an even bigger move here, I can actually lower my 1-to-1 on the remaining stock that I have, and maybe I'll be able to get that filled when I otherwise wouldn't. But then I'm not going to have a huge core position if this thing really goes. That's a more defensive game plan. The less defensive game plan, which is actually what I would usually use, would just be to sell the 100 shares at 1-to-1 and still have 1-to-1 out on the original 200 share buy. So that way, if this thing fully works, I have an even larger total core position that is risk covered, and it's from a better average price. So, and again, I know I'm like talking through this, and I can kind of talk through it in my mind a little bit, because I've kind of done, I mean, this is the stuff that I'm doing almost kind of rapid fire in my own trading, in my own brain as I'm doing it. And the reason I'm able to kind of do this a little bit rapid fire in my brain is not because I'm a genius or anything like that. It just has to do with the fact that I've just done it so many times. So that's what I'm going to encourage you guys to do as well. Think about and play with those game plans. And for the most part, you should have a game plan, and then you should stick to it. But maybe as your game plans become more advanced, you can have a more aggressive or a more defensive game plan, kind of based on what the stock is telling you. But whatever game plan that it is that you choose to follow through, you should choose to also be consistent with it, and you should kind of ride it out. And then eventually, I kind of cheated on my trailing rule a little bit. When we had this high in here, I kind of viewed it as good enough, even though it wasn't a new high yet on the day, where I then raised my stop to the low of the day, and I got stopped out when this thing actually started to break down, like right here. And because I was able to do it that whole way, and because I traded it like I did, I was never able to get my 1-to-1 kick on my core, right? Because I was buying 47.05 with a 50 cents worth of risk there. But between the couple buy and sales I was able to do, and then the raising of the stop, even with having what equates to being a straight loser on my initial buy, I was able to be basically, break even more or less in the trade. So that is the thought process on that. I'm just seeing what looks like a follow-up call from Gabriel. If you lower your 1-to-1 for your core, then that doesn't take out the gain for the 1-to-1 on the ad. I mean, shouldn't we keep each entry independent of each other? You can do it either way, Gabriel. And the math actually works out to be the same. It's just the way in which you view it and game plan it that changes. You can have each entry be entirely independent of each other, or you can utilize the entries based on a sum of how many shares and average price that you have. That's actually going to be up to your discretion as a trader and what game plan you're, again, choosing to implement for that situation. Paul looks like he also has a follow-up on this question. On this Bank of America review. Missed a part of the meeting. I can go back and listen if you already covered these questions. On the Bank of America trade, why was the stop the pre-market low if there isn't much volume? Okay. Also, Apache. I'll save the Apache question. ET asked me the question during the day on Bank of America on why I was using the low, and I answered it to him in the chat at that time as well. And basically the answer was this. I think that a good out that you could use, but it's a very tight out, so you could get shaken out, was yesterday's high. I think the ideal out that you could use would be yesterday's low. The problem with yesterday's low, in my opinion, is it's too much risk. I don't like what it does to my risk reward. So again, if I'm buying 47.05, I'm using yesterday's low. That's going to be 75 cents worth of risk. So I want to find more of a happy medium type stop. So I chose I will choose sometimes to use the pre-market low. Pre-market lows are not ideal for stop losses because of exactly what you're saying. Why is a pre-market low important if there's no real volume going on? And there is no real volume going on. I mean, Bank of America is actually a fairly liquid stock, so it does trade a bit pre-market here. But for the most part, especially when it was putting in this, actual 55 low, this was done on absolutely no volume. So I don't really have a fantastic answer for you. It's just that I'm trying to find a happy medium between giving it all this amount of risk down to yesterday's low and keeping it too tight to yesterday's high. And one of the questions somebody also asked me in the VTF was, I know a couple people used this bar's low, the first bar's low, as your stop loss on it, and that I don't like. I don't like the idea of using a negative Maribozu type candlestick as your stop loss. Maybe if you bought the inside 5 and up here, you could use the inside 5 low or this low as your out. But if you were in from prior to that, it means that you were already giving it more risk to begin with. And then when this thing bounced, you're like, oh, thank God, let me put in a stop loss somewhere. And this is not necessarily a real, if you have a negative Maribozu here, it's not necessarily a price that is important, right? Because prices that are important are going to be prices where it's either like an ignition bar because you got the big volume that's coming in, or a price where a change occurred. A change where buyers took control from sellers or sellers took control from buyers, an inflection point. And you can utilize that inflection point as your stop loss also. So there's a lot of different options there that you can use. Again, the ideal stop is yesterday's low, but yesterday's low just ruins the risk reward on the trade, I think. Even 50 cents risk on this thing is a lot. But, the idea sometimes with the bigger risk a little bit is that you can hopefully raise the stop. But I didn't want to give it all the way down that extra 20 cents. What's our Amazon doing? Still going? Man. 3,300. Just about. So sick. So sick. So sick. Did I have anything else I wanted to talk about? I think I basically covered it. We went over the market, we went over Facebook, we went over Amazon here a little bit after hours, we went over the oil names, we discussed the Bank of America trade. I think Snapchat, what's Snap doing? Snap, man. Beast mode. I guess maybe Snap is eating Zuckerberg's lunch a little bit, right? Wasn't Zuckerberg whining that the competition is too strong? Part of the reason why he's whining the competition is too strong is antitrust. I guess there's your competition. Even though Facebook loves to steal everything that everybody else does, holding in really well is this Snap. All right. I know I already answered some questions and I didn't answer some questions. Let me go to the top here and find questions. So we'll go into our Q&A portion here. Oh, I have a 5 o'clock today. They can wait 10 minutes for me. All right. Again, a lot of chatter here on earnings that I'm trying to scroll through. So if I miss anybody's questions, please tell me. Gabriel asking me if I still like Apache tomorrow for a break of 35. I do. I really wish it hadn't broken yesterday's high today and we could have had a daily shooter. But I think Apache looks fantastic. It's building out a bull flag. We should be looking at it into that $35 zone for sure. I like it. From Feeling Bullish. Hello, Derrick. How do you feel about drawing algo lines and using them as levels? Are algos more important than levels of support or resistance? So levels of support and resistance are going to be really important. I don't necessarily know about more or less important to other things. I just know that they are important because I understand what creates support and resistance. I don't really care about 5 or 15-minute chart support or resistance intraday. I'll look at it, but it doesn't matter as much to me. I care about daily chart support and resistance because daily chart support and resistance is created by the big money. It's created by institutional money. And it's the institutions that are, really moving big stock, right? So that's why I care about that. algo lines. I don't know what that is, to be totally honest with you. I don't know what an algo line is. I don't know how to draw one. So maybe you'll be able to provide some information to teach the team about that. I don't understand how an algo line could be something that could be created, because I mean, what does it mean, right? There are so many algorithms. I'd be curious to know if anyone knows this statistic, because I don't know the answer to this. What percentage of the volume in the New York Stock Exchange or the NASDAQ is done by algorithms on a day-to-day basis? I'm going to guess 80%. So, and that's a guess. But if my guess is accurate, or even somewhat in the realm of accuracy, you have so many algorithms doing so many different strategies at so many different points in time. How could you create a line off of that? You got all the types of algorithms doing all types of strategies. You've got pairs trading algorithms that are doing mean reversion. You got high frequency trading algorithms that are just owning orders from Robinhood traders and jumping in front of them. You got other high frequency trading algorithms that are just jumping in front of different points of liquidity that they see in the market and trying to make spreads. You've got other types of algorithms that are technical. They're driven based on technical indicators. You've got other algorithms that are execution algorithms for funds that are just executing to buy or sell, lots of stock in a certain manner because the fund says, hey, I need to accumulate 500,000 shares of this position. Robot, go ahead, do your magic, and give me my stock. And sometimes those are as simple as buying on the VWAP, or buying on the 80 EMA, or buying on the 21 EMA, or buying on some moving average. Or sometimes they can be, significantly more complicated than that. So the idea of an algo line is personally foreign to me, but I'm learning new things about trading all the time. So if you've got some information there and you can teach me some stuff about it, I would love to know it. Next here from Sebastian. Do you think that trying to buy the 3-bar plays in energy today would have been a good game plan, even though the market wasn't on our side? So I don't really know what a 3-bar play is either. I'm assuming that what you're talking about is, we've started to call it this 1, 2, 3 trade recently, where like ExxonMobil here, this is day 1, day 2 is the rest day, the inside day, and day 3 you're looking for momentum continuation after a day of rest. This has been a trade that we've looked at as a team for a long time. It's just never really kind of had a name. Just inside and up momentum trade is what I always called it, right? Here's your momentum, here's your rest. The rest is represented as an inside day, so an inside and up momentum trade. Lately, some people have been calling it a 1, 2, 3, and that's kind of been cool. So I assume that that's what you mean, and it was on my game plan today too. Relative strength in a company like ExxonMobil, there really could have been a great momentum trade that could have come in on the break of it. So I had all the energy names on my radar again today as buys. I did trade some Apache back and forth a little bit today, but none of them really triggered. I mean, Apache actually did trigger. I didn't like when it was going. I didn't like the time of the day. I didn't like the extension on the actual break. So I told the team I wasn't getting involved in that break. I know Josh was asking me in real time if I was looking to buy 34.90 in Apache, and I just said I think I'm going to wait and just sit on the core position I have. And I'm personally glad that it didn't close well, so that can still be in play for tomorrow. So for sure, Sebastian, thanks for the question. From DJ, what do you think of a 3 EMA for someone who only day trades, doesn't hold overnight? Worth using or not a fan? I've never implemented that. I've never looked at a 3 EMA ever. My general thought process is it kind of reminds me of people who like to look at 1 and 2 minute charts on stocks. I just think that it's too microscopic. Even if you are a pure day trader and you don't keep positions overnight, I personally think that 2 minute charts are too microscopic. They're too easily manipulated, and it's too easy to manipulate your own brain to thinking that something is important on a 2 minute chart when it's not. Maybe a 2 minute chart in the first half hour of the day, or maybe a 2 minute chart if there's news you can look at. But for me personally, on those time frames that are that small, I'm almost better off reading the tape. And the 3 EMA, it's not something I've ever looked at or explored. I don't have an expert opinion for you on this one. It just kind of strikes me as just a little bit too tight, a little too much momentum-y there. Paul had a second half to his question. Also on Apache, the trade was versus the low of the inside low. What is the significance of that low? For me, I was really just buying back stock on my trade 2 days ago. Whoops. My trade 2 days ago in Apache. It was 2 days ago, right? I'm like losing my mind. And I did the same thing yesterday. Yeah. Apache, we had the trade 2 days ago through 33.55. Great little move. Yesterday, I was consistently buying 34 quarter and looking to buy 34 as well, and then selling like 34.50. So I was able to do that a couple times yesterday, and then I was able to do it like 5 times today. I just kept like adding some stock at 34 quarter, selling at 34.50. So it was just add backs, like the cash flow stuff that I'm talking about, off of my original trade. That's all I was doing. I didn't take a new ad in Apache today. The new ad would have been the break of yesterday's high or the break of 35, and I pulled out from that just because of the reasons I already explained. And that would be an ad, not an ad back, if I did that. So again, there's a difference there. Oh yeah, guys, I forgot to mention, for people who are members of the Pro Desk, either you're a subscriber or you're a professional trader with T3, the T3 team they emailed out a, what do they call it, a survey type thing today. So if people don't mind, if you could spend 3 minutes or whatever and fill out that survey so that they can collect the information that they want, I would really appreciate that. That benefits me. If you want to write nice things because you think I do a great job, that's great. But if you want to write bad things because you think I suck or there's areas I need to improve on or whatever, I got no problem with that either. It just it helps the team over at T3 Live with some of the initiatives that I've been kind of pushing for on my end, like getting them to take the time to build out that execution trade list that I've mentioned a couple times that I want to get going soon as well. No problem, Mike. Yep, it is another day. Today was definitely a crazy day. Sorry about that, Mark, but I appreciate you trying. All right, gang. Looks like we got through the questions. I'm interested in a couple of you guys got it. Check your spam also. I appreciate the questions. Great job here, team. I do have a 5 o'clock meeting. It looks like we got through the questions. That zero hedge comment that Josh has posted. Bezos is up $15 billion and Zuck is down $30 billion. Cody here has a question. Question on add backs. You mentioned you kept a core position in Apache but kept adding back and selling. Each time you do that, does it change your average price on the core position? It doesn't matter. It doesn't matter. Do the math on it. It doesn't actually matter. Yeah, I guess it does change the price on my core position, but you can build that out in a spreadsheet in such a way where it doesn't actually matter. The math actually stays the exact same, even as the machine tells you that your average price changes. Play with it. You'll find that as the result. All right, gang. I'm gonna jump. Cool day today, I guess. Insane day. Tomorrow, probably gonna be an insane day too. I'll see everybody tomorrow morning.